struck by a JP Morgan note this morning looking at historical analogs when you have political uncertainty like this. Constitutional conflicts like the impeachment process are rare events with market outcomes too context specific to graft easily onto this saga. Right? Does it mean anything, history, in this case?
All right, so this time may in fact be different. I think, why does all this matter? This all matters to the extent that it affects policy uncertainty and how that policy uncertainty feeds back into the outlook and to market uncertainty. Now, there are times in the past where you could say market uncertainty has actually very little bearing on the outlook and on markets. In fact, 2018 is a good example. Heightened policy uncertainty in the United States, no clear indication that the outlook was affected by it or markets even cared about it. That's different today. So there's evidence that, as the ebbs and flows of the trade war have gone on, it's increasingly feeding back, not just in terms of the outlook and the drag on spending and hiring, but also in terms of market uncertainty ebbing and flowing right along with it. And so this matters today insofar as it could interact with existing sources of policy uncertainty and continue to act as a drag on the outlook. And so with that as backdrop, we're fairly cautious here in our multi-asset portfolios, sitting somewhat underweight on equities.
Changing any allocations?
I mean, the thing is, we'd already been cautious about 2 months ago as the trade war ratcheted up, and so I think to the extent that this is supporting that drag on the economy and a lackluster sort of corporate environment in general, we haven't changed anything just yet.
I would argue that it's not so much policy uncertainty, but it's election 2020 uncertainty, because what makes this time different than Nixon and Clinton is that it's happening in a first term.
Yep.
And it feels like increasingly investors are caring what happens in the 2020 election, especially when you have candidates like Elizabeth Warren charging ahead. So as an investor, is it too early to make a call on that or to make trades on that?
It probably means you're not swinging for the fences in either direction, right? So we're cautious, but moderately so. I don't think we see this as being the end of the current expansion, nor do we see any clarity on policy and the politics of it until the beginning of the year, until the race becomes more certain in terms of who's even competing on the Democratic side. And so, to the extent that markets have chopped around but haven't really trended directionally, you'd expect more of the same on that with some downside risk.
We're going to keep our eye. The president has a busy schedule this morning. We'll monitor that. If we get any comments from him, obviously, we'll bring them to you. Shawn, how about you? Does the market truly care here about how this draws a line back to trade, back to rates, anything like that, the dollar?
I think it has to care because you're still in a scenario where you have a lot of uncertainty out there. So you have policy uncertainty. You have certainly the election cycle of next year is going to come more and more into play as we get into the fourth quarter. You have earnings that are actually decelerating and will continue to do that. So I think the markets right now are acting incredibly well and too well in some ways because everyone is complacent. So the equity market, everyone feels like because I can discount back to a 1.7 10-year, I have the ability to go long equities. So there's an underlying bias there to do that. But if you look around at the markets, you look at copper and how that's trading, you look at some of the other metals, there are some issues that are out there, and you still have the amazing $13 trillion of negative yielding debt that's out there as well, including $1 billion of corporate debt. So the markets are really complacent right now when they shouldn't be. So I think you're supposed to be very cautious here.
But, I mean, to that point, Shawn, the Fed can just keep it going. It's only begun to cut rates. We've only seen 2 this year. I mean, how can they prolong this sort of cycle and this mood of risk-taking and buying bonds?
They can, but the Fed is the last central bank that is not pushing on a string. So they have the ability to push a little bit further, so I agree with that. But if we look at it on a global basis and global growth, most of the other central banks that are out there are really pushing on a string, and they have to change their stance and get the fiscal stimulus as opposed to what they've been doing, and that's a slow... That's a much slower way to put money into the system. So I think the Fed can help a little bit, but they're cautious as well. If you look at Powell, he's talking about how there has to be a change in the dynamic of what's going to really drive the economies going forward. So I think from a global perspective, growth is slowing, and you're going to be in a scenario where the Fed can help a little bit at the margin, but it's only a little bit going forward.
Could I end on a positive note here? I think if we do end up getting through this period of policy uncertainty, this cycle could go on for some time, and the Fed is an important part of that. So the housing number is evidence that lower rates are passing through into the real economy. This is an important shock absorber. So I agree. This is the Fed is not going to prevent the next downturn, but just to say, if we can get through this period of uncertainty, this cycle could go on for some time.